Welcome to GexPro Daily Market View. The tape opens firm, but it's messy under the hood. Indexes grind higher while leadership fractures, and that's the risk. We're green on the surface, rotation underneath, and tech is no longer carrying the water. That disconnect matters, especially this early in the year. Look at the liquidity backdrop first. Central banks are on pause, not pivoting, and cash is still sloshing around. Rate cuts are in the rear view, but financial conditions stay loose enough to keep risk alive. There's no funding stress yet. That's the key word. Yields aren't screaming, the front end behaves, and nobody's panicking. Complacent? Yeah. Broken? Not yet. Now, here's the kicker. Sector rotation is doing the real talking. Growth is leaking while value gets paid. You see it in real time. Tech under pressure on days when almost everything else catches a bid. That doesn't happen often. Industrials, materials, health-related names, energy services, they're where the flows go. It's breadth, not beta. Old school rotation. Post-rate cut playbook. I'm watching leadership fatigue. The flagship tech complex prints red while defensives and cyclicals grind higher. That's not a crash signal, but it's a regime shift. The desk doesn't chase last year's winners. It hunts fresh liquidity pockets. Now shift to credit, because credit never lies for long. High-yield spreads are tight. Too tight. Junk isn't trading like junk. There's a full-on yield hunt happening, and nobody's pricing risk. Credit default protection quietly widens in the background, especially around data-heavy balance sheets. Bonds themselves don't flinch, but the edges do. That's your early warning system. Employment data creeps higher on the headline rate. And yes, the recession crowd is getting loud again. I'm not buying it yet. Labor data lags. Always has. It's a condition, not a trigger. Worth watching, not trading off blindly. Zoom into the tape. Breadth is strong. Advanced decline lines keep pushing higher, which tells you sell-offs get bought. This isn't distribution, it's rotation. But here's the tension. The growth-heavy index stalls while broader benchmarks make highs. That divergence is real. Levels matter now. On the main index, the options market is loud. The 6,900 print is the gravity well. Lose it cleanly, and 6,800 shows up fast. That's where institutional hedging stacks. Not lines on a chart, positioning. Single name action reflects it. Big Autotech is building a base around 430. That's put-heavy territory. Above 440, it breathes. 460 opens air. Semis are trying to double bottom, still fragile, still tactical. Commodities tell a parallel story. Energy services quietly rip while headline crude stalls under resistance. That's forward-looking demand, not spot price chasing. Metals cool off after a strong run, not breaking, just adjusting. Volatility enters. Easy money's gone. Now it's about structure. Copper holds higher lows. That matters for growth-sensitive trades. And crypto, different drumbeat. The flagship coin stays boxed. 86 on the downside, 94.5 on the upside. Months-long range, still intact. Flows improve short-term. Momentum probes higher, but nothing changes until one side breaks. When it does, it won't be subtle. So no fireworks, no collapse, just rotation, compression, and patience being tested. 3 things to watch. First, credit spreads. Not bonds themselves, spreads. That's the canary. Second, 6,900 on the main index. Respect it. Third, leadership. If tech keeps bleeding while breadth holds, the playbook stays rotational, not defensive.